warning signs for a possible recession continue to mount. The Atlanta Fed's GDP tracker is now signaling an annual gain of just 0.9% in the second quarter. Keep in mind that first quarter GDP fell 1.5%. This coming the same day as the OECD cut its GDP forecast for this year in 2023. Let's bring in Yahoo Finance's Brian Cheung to discuss this further. And Brian, another day, another dour read in the global economy.
Yeah, certainly. It seems like the hits just keep coming when we kind of pair this with the World Bank warning yesterday. They lowered their forecast for global growth this year to 2.9%. And the OECD, again, the Organization for Economic Cooperation and Development, also downgrading substantially their forecast for growth this year to 3%. That's down from 4.5% from their last forecast. Now, what's really interesting is that that's a global kind of measure that we're seeing there. Now, again, the OECD is careful to say they're not projecting necessarily a global recession at this time. The World Bank is not doing that either, but they're saying that the risks of recession, particularly a stagflationary environment where you have low growth but high inflation, is still high. Now, here in the United States, a bit of a different picture, but interesting to see the Atlanta Fed GDP Now tracker, which kind of measures where the kind of next read on inflation for the second quarter could be. They downgraded their estimate for the next quarter of GDP to 0.9%. Keep in mind that we already have 1 quarter of negative GDP from the advanced estimate for the first quarter. So if there is a negative print on the second quarter of GDP, that would be that kind of informal definition of a recession, which people often associate with 2 back-to-back quarters of negative GDP. Again, Atlanta GDP now saying, at least for right now, that's still a positive figure that they're forecasting. But keep in mind, the margin of error for that measure tends to be about 0.8 of a percentage point.
Oh, that's big.
So it's pretty big. Again, forecasts are forecasts. We know that.
So the OECD, they had 3 key takeaways within the report, right? The war slowing the recovery, inflationary pressures intensifying, and then additionally, the cost of living crisis will cause hardship and risks famine, they say. And so with what some of the different regulatory bodies and policymakers are able to do they have the necessary tools in order to combat some of these very present risks to the economy?
Well, absent some sort of diplomatic solution in Russia and Ukraine, probably not, right? I mean, that's the biggest difference between the last round of forecasts that we got at the beginning of this year from the likes of the OECD and the World Bank and their updates now is the fact that in January, there was no war happening in Ukraine, no war happening in Eastern Europe. So that's the big reason for the downgrade here. So it's a little bit quick to just look at the revision and say, well, here's, the largest world international bodies saying all of a sudden, oh, wow, the global picture is changing because of central bank policy or government spending. It's really mostly just because of the Russia-Ukraine war. As far as what governments and central banks can do about it, well, if you want to avoid a stagflationary scenario, try to get ahead of inflation by lowering aggregate demand. You could do that by raising interest rates. We've seen the Bank of Japan, not the Bank of Japan, actually everyone but the Bank of Japan, Bank of England, Bank of Canada, the Federal Reserve doing exactly that. Of course, you can only lower inflation so much with supply chain issues, still a big driver of that upward pressure. Lockdowns in China, second largest economy, certainly a big part of that. Until you can figure that out, it's really hard to see how you can avoid that scenario.
I mean, on the other hand, even though you can't necessarily point the finger at central banks as a reason for the slowdown, the knock-on effects of them raising rates are substantial, right? And we had the latest example of that today in the Mortgage Bankers Association weekly index of refinancings and applications for mortgages. And it looked really bad. We saw a 6.5% drop in mortgage applications. And if you look at the aggregate, the lowest in 22 years. And that has a lot to do with rising rates because the Fed's been raising rates, and then you see benchmark mortgage rates go up.
Yeah, and the Mortgage Bankers Association kind of read on overall activity in the housing space also includes refinancing. I think that's going to be a big part of that, right? It makes sense that as rates go up, you're going to have a lot less refinancing, especially when you're comparing that to the period of, late 2020, early 2021, when everyone was refinancing. Why not? Rates were at near zero, right? So when you take a look at that overall economic activity in the housing sector, that's certainly a big part of it. The question naturally is, well, what's that going to do in terms of the overall aggregate economic activity here in the United States? That raises the question, well, how substantial is refinancing mortgage activity to overall GDP? Estimate is that it feeds into residential investment. That's about 3 to 5% of U.S. GDP, but consumption spending on housing services is much more substantial. About 12 to 13% is the estimate there. So whatever's happening in the housing space does have ripple effects into the overall aggregate.
We've been seeing that. We saw that yesterday with Target,
exactly.
which was seeing a pullback in housing goods.
And also, I would say all this ties back to inflation. And look, we continue to hear from some heavy hitters on the inflation topic. Here's what they've been saying this week.
As the war continues, it is pushing up inflation and slowing growth. Russia's aggression comes with a price we're all paying. Disruptions have driven up food and energy prices, which are putting a high burden on all of us, and especially the most vulnerable.
We currently face macroeconomic challenges, including unacceptable levels of inflation, as well as the headwinds associated with the disruptions caused by the pandemic's effect on supply chains and the effects of supply-side disturbances to oil and food markets resulting from Russia's war in Ukraine.
Stagflation is a really knotty policy problem because the remedy to high inflation is a policy that will have as a side effect stagnation or something worse. So that, both central banks and ministries of finance have to navigate this very narrow path between enough tightening to reduce inflation, but not so much tightening that you get a deep downturn, let alone a recession. So it's a really difficult balancing act.
So, Brian, whether it's naughty inflation or naughty inflation, both really aren't too good.
Yeah, we'll try to figure out the interpretation. I mean, look, either way you cut or slice it, stagflation is certainly the risk that everyone's worried about, right? If central banks can't lower aggregate demand enough, that's going to come alongside a slowing of economic activity, low GDP growth, high inflation. That's the worst possible outcome. Now, what's interesting about the global picture, though, is I want to emphasize that it's a global phenomenon, right? It's not just the Federal Reserve that's dealing with this, but we also have to keep in mind all of those lower income, kind of more impoverished nations that we don't tend to talk about on these programs. They don't have the fiscal space to pass any sort of targeted relief, for example. This type of recovery, if there is a recession that kind of ends it abruptly, could actually further exacerbate the divide between the advanced nations and
yeah, that really stood out to me yesterday in the World Bank report, right, is that those developing nations, that they could see post-pandemic growth at 5% below the pre-pandemic levels, right?
Yeah, and also keep in mind, I mean, the central bank picture is very important there because as the advanced nations that have the ability to raise interest rates, like the Federal Reserve, what is that going to do to those, other types of advanced, or rather developing nations that can't afford to also raise their interest rates? You're going to have a lot of outflow of funds going into U.S. denominated dollar assets, and that could really leave a lot of kind of ripple effects to those countries that are seeing outflows. I mean, it's not to say there would be a 1997 like Asian financial crisis again, but you do wonder whether or not the strength of the U.S. dollar is really going to suck a lot of momentum out of those other nations, which are still trying to recover.